Today, we're going to start the session with a conversation with Dan Roselli, founder and managing partner of CFV Ventures. Dan, welcome to the show.
Thank you very much. It's great to be here.
Well, let's get acquainted. Let's get you introduced to our audience. Tell us a bit about your background, and also let's introduce the firm, CFV Ventures, your focus, etc.
Yeah, that's great. I kind of break my career into three components. The first one was big company marketing, so General Mills, Colgate-Palmolive, that type of thing. Mm-hmm. I ended up in Charlotte, North Carolina, which is where I am, because Bank of America recruited me to be their brand and advertising executive. So I ran brand strategy and Marcom for BofA globally and was a member of the management operating committee of the bank. Left that at around 2000, end of 2003, beginning of 2004, and became an entrepreneur because I wanted to stay in Charlotte. I helped co-found one of Charlotte's FinTech unicorns, a company called Red Ventures. Charlotte has actually produced 4 FinTech unicorns, and most people around the world may not know that. They know us as a big banking town, but they don't know us for some of the work in the FinTech area. I was an entrepreneur for about 10 years, put 3 different companies on the Inc. 500 list. Lots of entrepreneurs know about that. It's a U.S.-based study, but fastest growing based U.S. private companies. You have to have a 4-year track record to do it. So not that many people have done that. So I had this interesting combination of big company operating experience and kind of entrepreneurial street credibility. And that takes us to about 10 years ago in what I call the third phase of my career, which is I focus now on community building and helping entrepreneurs. We did a crazy thing in the last Great Recession and bought an empty downtown office building in Charlotte, North Carolina, with the idea of turning it into an entrepreneurship center. And that's called Packard Place. It's still one of the largest tech and innovation centers anywhere in the U.S. and really was one of the first ones outside of New York and San Francisco in the U.S. Our alumni raised over $2 billion in venture capital, created over 1,000 jobs in the Charlotte region. So just hugely transformative for the Charlotte area. And then from that platform, we started doing acceleration work in FinTech, InsureTech, and Health Tech. And then we also started a fund specific to the FinTech and InsureTech space, which is what we're here to talk about today, the CFV FinTech Fund. So as you can tell, I've had a busy decade here in Charlotte.
Fantastic. That's the kind of things places like Charlotte need. So congratulations on your leadership. So tell us a bit about the fund. How big is it? You've already said it's FinTech and InsureTech focus. What scale are we talking?
That's right. It's a modest fund. It's just around $7 million for our first fund, primarily because we're investing in an early stage. Our investment criteria, we normally participate in seed rounds that are $750 to $1 million in a total round. We like to be 200 to 300 of that round. So pretty early stage, and therefore we don't need a huge fund to have the impact that we want on the number of companies. And we do have a preference for companies that have come through our accelerator program. That's the Queen City FinTech Accelerator and the Queen City InsureTech Accelerator. I should note Charlotte's nickname is the Queen City because we were named after Queen Charlotte 200 years ago. So the QC FinTech and QC InsureTech program. So a lot of our funding goes there, partly because we believe we don't just want to be money. We don't want to just be a check. We really believe we're bringing an ecosystem of resources and support to the table, and money is just part of that equation.
And what does a company need to have by way of proof points to qualify for your funding?
Sure. So at a seed stage funding, right, I'll start by saying kind of what's next and then working backwards. In the United States, at least, and I think this is pretty true globally, Series A investors want to see about $100,000 in monthly recurring revenue. If you're a direct-to-consumer business, they probably want to see 20, 30,000 clients. If you're a B2B business, they probably want to see you have 24 clients, right? So that's where we're trying to get companies to. So we invest in the stage where they are certainly post-launch and post-revenue, and probably have some early signs of marketplace fit and adoption. So we're not totally banking on speculative entrepreneurs. We're not banking on people with ideas. We're not an angel fund, right? We want to see a product in place. We want to see a founding team in place. And we want to see some early marketplace validation that, yes, you are actually solving the problem you think you are, and then some people are willing to buy it. Now, lots of times that will change, but that's what we're looking for in terms of stage. Revenue still probably small, probably under 100,000 in revenue.
So if you are trying to get these companies to the Series A, which means in the event it's a SaaS company that's of 100,000 MRR, what is your MRR threshold? 10K, 15K? What is your comfort level?
Yeah, we don't have a hard threshold, but I would say we would like to see, 5 in ARR. And even at that point, so low, I'm not even sure we could call it ARR on a monthly basis. But like I said, we would love to see, even if it's 50,000 in annual revenue, and most likely, because they're young companies, that will be over a course of, a couple of months. So if they had 50,000 in revenue over a quarter, but had some people that were able to be case studies for them, endorsers and references, that would probably suffice. There are times where we look at companies that are pre-revenue, but it's rare.
Good. All right, let's talk about some of the companies that you've invested in, and give us a sense of what are they doing, what are the business models, and what trends are you seeing in FinTech? It seems like, since this is your sweet spot, you have, I'm sure, a good investment thesis around FinTech and InsureTech. So I would love to pick your brains on that.
Yeah, absolutely. So you asked a bunch of questions there. Let me start with talking about some of the alumni. We have always had a philosophy of creating a really wide tent within FinTech and InsureTech. We believed that by being specific in those verticals, that was already specific enough, and then we wanted to be as wide within those verticals as we could be. So FinTech for us could be everything from cybersecurity to AI, to blockchain technologies, to P2P lending, right? We really go the full gambit, and we think that allows us to get the best companies and the best entrepreneurs. Some notable alumni companies, it's always hard to pick your favorite children, right? So if somebody I don't mention on this is gonna email me afterwards and go, how come you didn't give us a shout out? But our portfolio is about 80 companies because we're at a pretty earlier stage. One of my favorites is a company called Trust Stamp out of Atlanta. They do work on biometric verification of consumers. They've actually announced that their intentions are to go public on the Ireland Stock Exchange later this year. So that would be our first IPO, which would be exciting. We had a company that's actually based in the Charlotte region, Catapult, that manages RFP processes for companies. And we think that marketplace in the RFP is even something we define as FinTech. They just did a major raise and a markup in their valuation. Another company called Amicus that deals in DAFs, donor advised funds, and has just landed an opportunity with a major, top 10 global bank. Excited for that announcements that are coming up. So you can see even from those 3 examples, the spectrum of things within the FinTech space we look at. In InsureTech, it's equally broad. We look at everything from carrier innovation to back office innovation to claims. There is a whole bunch of work being done on claims automation. One of our companies in our last cohort, weather check, is actually using data and AI on a microclimate basis to understand potential weather damage to expedite claims processing for damage from weather-related issues in the U.S., right? Just fantastic technology saving insurance companies, hundreds of thousands of dollars in inefficient claims processes. So I could talk all day about that, but hopefully that gives you a little bit of a flavor for the alumni base. You also asked about... Sorry, go ahead.
Give us a sense of the trends in those 2 sectors.
Absolutely. And so the biggest trends tend to be around AI, machine learning, and that automation space. I know those are a bit of buzzwords, so I even hesitate to use them, but this idea of creating efficiencies through the ability with machine learning to make processes more efficient. These organizations that the FinTech and InsureTech companies, founders that we work with, are trying to work with are such huge organizations that even a small increase in an efficiency in a process has huge yield to it downstream because they're just so massive as organizations. So we see, well, that's not particularly sexy, the efficiency play on an institutional level for financial and insurance companies, may not get people totally excited, but it's big money, and there's some really good companies in that space. The other thing I'll say is that I just did a conference or an event last week on blockchain, and I believe, and I showed the technology curve in that session where, especially in the U.S., and I think this is true globally, you get this innovation hype, and then you get this hangover effect where things get overhyped, and then the reality starts creeping up, right? You could put self-driving cars in this category, which everyone expected there to be self-driving cars, and now they're not, and then all of a sudden there are going to be self-driving cars. I put blockchain in that same technology curve, which is got really overhyped. People use it as a buzzword. People really didn't know how to use it or what it was going to be used for. And so for last year, we've been in this hangover from the blockchain buzz, but now we're starting to see some really core, interesting technologies using immutable ledgers and how that can work to make processes from lending to claims more efficient. So I think you're going to hear more about that coming back soon.
Very good. All right. And now, what is your modus operandi? You have a small fund. Are you looking for unicorns? Are you looking for early exits? How do you think of,
Yeah, certainly.
the fund?
Well, clearly, all of our portfolios will be unicorns someday, right? We know as an early stage investor that we will still have a relatively high failure rate of companies. If you look at the failure rate of companies in general, at the early stage investing, you get less of that at the Series B stage, where the companies are viable. It's a question of how big are they going to get. But at the seed stage, you're still trying to figure out, is this company going to make it? And so we think for us, and because we're investing in valuations that are 3 million, 5 million, 8 million, a company that gets to 80 million is an interesting exit for us, right? It doesn't have to be $1 billion valuation. It needs to be $1 billion valuation when you're putting in $50 million at a Series B when the company's already valued at, $100 million. That's where you need to get to unicorn status. Could some of ours grow up to be on that path? Sure. I mean, having co-founded one, I know what that trajectory looks like. But I don't think that's necessarily our goal. The other thing that I would say is I think we'll have a myriad of exit possibilities. I mentioned one of our companies, we're going to have our first IPO, which went out of fashion for a decade and is now kind of coming back into fashion as startup exit modes. We think the more likely paths for most of our companies are going to be strategic exits to a company that's going to want to buy and bolt on this technology, service, user interface, AI learning they have behind the scenes. And we think that'll be a very common exit path, much more common than kind of unicorn status and Series D rounds at $1 billion valuation.
Ted, what is the geographical footprint of the companies that you invest in? Because you said your preference is for people coming out of your accelerator, but then you also give examples of companies from Atlanta. So it sounds like you are not completely constrained to just the North Carolina companies.
Certainly not. I think we do focus in the U.S. and Canada. We happen to be based in Charlotte, North Carolina, but we don't focus on Charlotte or the Carolinas. We will get companies that come through because we're a hometown team, but really our perspective has been global in nature. We have had applicants. We're recruiting for Class 13 right now, so that's one thing I should mention to all your listeners. Applications are open for another until I think August 1st. And so if you want to apply to Class 13 of the QC, FinTech, or InsureTech program, please check out the website. And we get people from all over. So I think over time, in recruiting 12 classes, we've had companies from every continent except Antarctica, 100 different countries, almost every state in the United States. And so really wide geography. That comes from the fact that we focused it on a couple of verticals, starting in FinTech and then InsureTech and now Health Tech. Because we thought we had an ecosystem that could support that. When we started the program, we said, what areas can we compete in, sitting in Charlotte, North Carolina, that we can compete on and win on a national and international level? That was part of our thinking of why we chose to be vertically specific. And as soon as we started doing the FinTech program, we got applicants from all over the world. And I'll never forget 8-9 years ago, the first time we got a company from New York and San Francisco to move to Charlotte to incubate their FinTech startup. how much that changed the mindset of what was possible. And that was just as this movement in the United States about being in traditionally kind of underserved marketplaces, primarily outside New York and San Francisco, how much that the rest of the country has to offer, cost of living, quality of life, valuations. And so we've really driven behind that tailwind. The last thing I'll mention is international, because it's important. We get a lot of international companies applying to our program because they want access to the U.S. marketplace. And so we've actually created a whole nother program across those verticals called the International Landing Pad, with the idea that people can come in, make Charlotte their North American home base, and we can help them access the U.S. and Canadian marketplace. We think much more cost effectively in New York, much more connected, less expensive than San Francisco. So we will look at companies that are coming through that program as well.
Yeah, I'm completely in agreement with you that the trend is very much in that direction. I think it's going to be, companies are not going to be doing their, entrepreneurial work in expensive places like New York and San Francisco or the Bay Area. At least maybe they'll have one or two people, and then the real bulk of the operation is going to be somewhere else, and that's definitely going to be, has been actually, I mean, part of the success of our program has also been because of this global nature of entrepreneurship, and in the last couple of decades, the movement has been towards global, especially in the last decade, the movement has very much been in a global direction. So yeah, absolutely.
I remember 10 years ago, if a startup in Charlotte had gotten Series A funding from a venture firm in New York or San Francisco, it was almost certainly a requirement that they had to move to that geographic location. And now, 10 years later, VCs in New York or San Francisco are saying, absolutely don't move, stay where you are. We love that cost of living. We love the value and the impact of our investment in Omaha, Charlotte, Jacksonville, Nashville, right? So we're seeing that is truly happening, and same on the international stage.
Yeah, and this upcoming decade, for many reasons, including COVID, is going to accentuate that trend big time.
Totally agree.